Hey, thanks, Karthik. I hope all of you can hear me loud and clear. Um uh, Extremely happy to do this session. We've done this couple of quarters ago. I think we thought it's good to always come back and continue doing this so that whoever is kind of not yet been able to participate, they're able to ask us questions more than anything else, as we also put out a few things from our end. But I think it's pretty open to for you to ask a lot of questions on what on the funding terms, or how does startup funding kind of happen. Yeah. That's where the agenda is for today. Happy to get started, Karthik. Yeah.
All right, Vinod. So I think the first thing that we wanted to discuss last time, we discussed a bunch of topics around startups, right? What is the term sheet and so on and so forth. We discussed some of the things that we keep hearing is, what takes a startup from seed stage or an angel stage to Series A, right? Um, so let's talk a little bit about that. When do follow-on fundings materialize for startups, right? And what do investors look when they are looking for follow-on investing? And what is follow-on funding? In short, if you can explain that. Vinod, can you hear me?
Yes, Karthik. So I was just trying to juggle between the two. I think follow-on funding, right? When a startup is already funded, right? Right, the next round of investment is typically called the follow-on investments, right? Like for example, if you have funded a angel round, then your seed investment, upcoming seed investment, will be your follow-on funding, and the further rounds, right? I think there's a lot of nuance on of a follow-on funding also, simply because uh, who you've taken money from in the earlier round sometimes matters, not in terms of credibility that I'm talking about, in terms of signaling largely, right? For example, let's assume you've taken in your earlier round money from a larger investor, and that larger investor is not participating in your follow-on round. That kind of sends out a signal saying, look, if that investor who has an inside view on the startup and it's functioning over the months, or over the quarters, if he is not willing to participate, right, why would somebody external, maybe a smaller fund, would want to kind of participate? So that's one of the reasons we kind of suggest startups, right? When you're taking funding in the earliest rounds, right, it's good to take funding from investors who could actually assure you, or or say that they will support you in your future rounds, or take it from investors where there is no signaling risk. If they don't participate in a further round, they don't create a risk saying why didn't they participate. If I have to give you an example, right? For example, let's say you took money from a bunch of angels in the next round, right? There's no signaling risk because the VC clearly knows angels don't participate in follow-on funding rounds. They don't have that kind of capital. So, but if you have taken it from a very large investor, then if the next set of investor that you're going is slightly smaller than this large investor, then there's a risk of they're not participating, given that this large investor itself is signaled that they may not participate unless this large investor agrees to participate and is very clearly said, look, I'm willing to participate. Then there could be a clear possibility. So that's the risk with follow-on rounds that startups kind of can run into. Karthik. Yeah. I think you want to add on to that? Go ahead. Yeah.
Yeah, I think that's a great response, right? I think from the word follow on itself means that an investor is actually invested in a company already, and he is looking to invest in the same company in the next round, right? So it could happen in like bunch of different scenarios. A scenario where the company is actually doing very well. There could be a scenario where the company may not be doing very well. right? These are the two basic scenarios, but there could be other things as well. If the company is doing extremely well and the investor wants to preempt the round, that is an interesting sort of a situation, right? um, so all of these things, these are all they sound similar, and look, appear the same, but they're done in different situations, right? I think one of the things that an investor will keep in mind is the multiple on the investment that he's making, right? How does he maximize that, especially if you're a fund and you're raising money from a fund, right? The fund would want to ensure that the fund would give a decent return to their investors, right? Which means that they're building a portfolio of these companies, and of some of these companies, one or two will be doing very, very well, and they may want to double down on those companies, right? So the investor will be faced with a conundrum of, okay, should I back this winner, keep backing this winner, keep allocating more and more funds into this company, or should I prop up a company that is not doing very well? At the same time, it's also not a terrible company, right? But it's not growing as fast as some of the winners in the fund are growing at, right? So though that's the conundrum that the investor faces, and it depends on the situation. Depending on the situation, the investor will decide whether to go ahead or not, right? But broadly speaking, um, what could be what how do you explain the difference between a bridge round and an extension of a previous round? Are they one and the same? If not, right, what are the situations where a founder can potentially go for a bridge round versus extending a previous round, and how is it perceived?
Yeah. No, I think that's an interesting question, right? Like bridge and extension, right? Two different things. So, an extension, right, is like you already agreed on certain set of terms, which is valuations and how much of equity that you're diluting it. You are raising an additional money on the same terms. I think that is an extension of the round that you already completed, right? See where this can happen, in case you don't want to wait for the round to close. You just want to close and keep it open for, let's say, 6 months, so that you could add more capital. Because the capital has not come immediately, or investors have not committed to the capital immediately. That's kind of the possibility. This typically will take some form of convertible note form, or you keep the round open in such a way, even if it's a priced equity round, you say, look, up to 6 months, any investor coming in will be provided the same terms. That is a round extension. That means it's happening immediately after a proper pricing round has been done. That's a round extension. It could happen at slightly higher valuation, also marginally higher. That's a term of negotiation that the founder or the new investor coming in can do. Bridge, right? Actually, it's a term itself, really people shouldn't use, is my view, frankly speaking, because it has, at least within the investors community, or general sense, a bridge is a bridge to something, right? That means you are not able to cross in the first place. You need this capital to move from a point A to point B, and and you are at a stage where you may be running out of money. That's typically a bridge. A bridge is almost calling any round a bridge, right? You are sending a almost a negative signal to investors. So I think, ideally speaking, you should not use a bridge round, and rather say, look, this is an additional round that I'm raising, whatever that you want to call it. It could be pre-series A, pre-seed, seed. I think, that's a better nomenclature in terms of naming a round. And anyway, these names have no significant bearing on the size of the money, or, on where the company is at what stage. It's much more, what, at any point in context, right? Investors use a certain, say, series A, series B, right? I think there is no fixed criteria or objective criteria to define any of this. So with that in mind, right, I think ideally you should not raise a bridge round, but typically bridge rounds are, uh, you should think of them as, you would potentially run out of money, but you can't raise a larger round because you've not crossed enough milestones. You need additional money to show that you can cross to a particular milestone with this additional capital that you want. Typically, that's why people are calling it a bridge round, but you would ideally not call it a bridge round when you're raising it, actually. Yeah.
And the in terms of the round extension, right? the timing also becomes rather important, right? I mean, if you have raised a round right now, and if your extension doesn't happen within a shorter period of time from the time that you raised, right? I think it's just a fancy way of saying a bridge round, right? It's no longer an extension round. It also kind of sends a message to the investor community outside that the company is somehow unable to raise at a higher valuation, right? And especially in this market, where there's plenty of capital available, and I think that could uh, be sort of a rather sticky situation for founders to be in.
Yeah, yeah, I think absolutely bang on, Karthik. So I think, founders should think about what they call their round, because we've seen many decks, it says I'm raising a bridge round. I mean, that's like wrong signaling in the first place, right? You say, look, I'm raising money. I have not achieved my milestones, but I need money. If there is real conviction in the investors, right, that they will anyway invest. So I think, it makes sense not to put yourself, in a position of weakness by calling it a bridge round. Yeah.
Great. And also, let's talk a little bit about the internal rounds, right? What we call the internal rounds. And then we'll open it up for questions. And I think we already have some questions pouring in. I'll keep adding these gentlemen and ladies to the queue so that they can queue up their questions. Um, but so let's talk about internal rounds, right? Internal rounds are essentially the rounds being led by the same investor who has already invested in your company, right? But this could happen in two different situations. One is an opportunistic situation where the company is doing extremely well, and you want to preempt the round and ensure that you invest. And the other situation being, the company is not doing very well right now, maybe because there are some extraneous circumstances for the company, right? Maybe the market is particularly bad a particular year because of some external event, but the company's fundamentals are still strong, and the company may find it difficult to raise in those kind of situations. So the investor may choose to sustain the company by putting in the investments, right? So there are two situations, opportunistic versus this, right? Um, have you seen this very often in our ecosystem? Like, have you seen a lot of internal rounds happening? Why or why not? How are they perceived in general? And should founders go for it?
Yeah, I think, as you said, right, Karthik, opportunistic versus, not so great situation, right? We can call them as up rounds, and down rounds if you wish, right? In some sense, in some form, I'm just calling, not necessarily a down round. The If an internal round, and if a company is performing pretty well, right, and if somebody wants to do an internal round and they're saying, let's not bring an external investor, it's an indication that the company is doing phenomenally well, or the growth has been extremely good, that the existing investors want to capitalize by taking more ownership, which is a great situation, from a validation of the company's point of view. But I think the founders should also note one thing in an internal round, right? Valuation is not being discovered by a third party. Valuation is being set by the existing investors along with the founders, whatever they agree. That introduces a slight conflict of interest question, especially if existing investors are themselves setting the valuation of the next round. But it doesn't have any legal implications per se, but it is a conflict of interest situation saying, are they assigning the right value? Are you discovering the right value? If by bringing in a third party, right, typically, there is this clear demand supply situation, which creates a right valuation is what is assumed. But as long as the founders and the existing investors can agree on a fair valuation, and if only you have to deal with the same set of investors, an internal round in a fast growing company is actually pretty good. And I've seen that, a few companies, but it's not a norm, I think, Karthik. It's a rare, I wouldn't put it rare, but it doesn't happen as often as, round where, there is one more new investor, an external investor who comes in and validates both the business model and also, sets the benchmark valuation where, the existing investors kind of participate, which is a typical round, right? I think an internal round is few that I've seen so far, especially, in the opportunistic side of it. On the other side, right, I think that's a common phenomena, if you ask me, which is, I don't want to call it a down round. Maybe let's say, the company is doing okay, not great, but it's not like it's doing bad. The company is doing okay, right? But there are no external investor interest that's significant, right? In such situations also, right, if the conviction of the existing investor is high, right, they can do a round at like maybe sometimes a little higher valuation than the last valuation, or at the same valuation, just to keep the company going if the company is in need of capital. I think that's again, is it a great situation? No, but it could still be a good situation sometimes. You just need a little more money when no external capital is willing to come in. I think that's the other part of an internal round that this happens often, I would say, right? Look, we all know that all startups struggle through valleys and peaks, and sometimes before you look at the next peak, right, you need to go to a valley before you hit the next peak. In those valleys, right, you will need your investors to support them by providing this additional capital, which could actually be the internal bridge. If Karthik say, which we were talking about, right, that is an internal bridge, and you need to be sure that some of your existing investors will be willing to take that additional capital and provide that the additional risk, provide more capital if required in the event the company is not doing well. So that, I think, is another kind of an internal round, Karthik. But I'm not going to talk about down rounds, because then anti-dilution, all that kind of comes into play, which is a lot more complex piece. Yeah.
Yeah, absolutely. So we have our first question from Satyam. Satyam, if you can hear me, please unmute yourself and go ahead.
Hi everyone. This is Satyam here. Um, Thank you for giving the opportunity. Currently in Canada, I had a quick question regarding like how this thing works. So I'm a part of a startup right now here, and while dealing with investors and pitching out the things which we are doing, we sometimes at the technological front are unable to, you know, just give away all the informations and the valuable uh, ideas which the company is working on and the progress which we are getting. How would that impact, say, for our first milestone, if we had a target and we achieved that, but we are very unsure about revealing all the other aspects for the next milestones to be getting the additional rounds of funding? How to tackle those kind of situations?
Uh, Satyam, I had a little bit of trouble hearing, but you're asking about milestones, right? And if you're not comfortable devolving all the information about the milestones for further fundraise, is that right?
Yes.
Okay. Look, I think the way that I would look at Satyam is, once an investor is on board, right, and he's probably sitting on your board or something like that, he usually gets the information rights, right? Especially if it's a lead investor, right? When he's making an investment, he would get all information and inspection rights. So as part of the information rights, he or she has the right to ask you for all the updates, right? And you can provide that information to the investor as well, safely, as long as you know that the investor is a financial investor, right? But if it is a strategic investor, I think at the time of you signing your original investment agreement, you'll probably have to negotiate on what are the kinds of access that you would want to give that strategic party access to the information, right? Irrespective of that, I think for milestones to be decided by your investor and yourself, I think you will have to disclose the information from time to time.
Right. So my question was regarding the later thing. Like, so we have like two kinds of investors. One are the big companies which are already in the picture, but who are still working with us on our technology. And the second are like just the financial investors, like who just want to invest because they have money, right? And they believe in a technology as well. I'm worried about the later ones. Suppose at some point of time we get to know that our technology is very different from what is a pre-existing, and we believe that the strategic investor, like some well-renowned technical company, can easily manipulate one or two variables in the same technology and do something of their own. That's where the worry starts.
Satyam, look, if there's if your company is banking on that some big company will manipulate, right? Look, this is a question that's often asked, right? what if Google does this kind of a question, right? Look, there is
Yeah.
no answer to it, and if Google does, we don't know. But Google is not as agile as you are in the first place, right? That's why you are doing it in the first place. Right.
Yeah.
Look, that's like a harder problem, but rarely that you would notice, a situation, because every startup, right, can say, if Google does this kind of a problem, right? But for, I don't think so. You should be worried about somebody, taking this feature. That means, you are on a weak moat in the first place. If it's in a situation like that, you are in a weak mode, right? I would say you should not worry about that. Actually, you anyway would sign an agreement with your investors saying you can't disclose confidential
We always
information.
have a non-disclosure agreement signed.
Yeah, I think you should trust them, to stick to them. Then you have recourse to law. But I think most people would, believe not to share it unless, or you should not share your super secret recipes, which you think, you shouldn't share it with anyone. Then keep it within the core team internally, if that's the case. Yeah.
All right. All right. Thanks a lot.
Thanks. Yeah.
But once the investor is on the cap table and you've already signed an agreement, right? I think it becomes very difficult for you to negotiate out of those rights. So you have to be careful, especially if you're bringing in a strategic investor onto the cap table to make sure what kind of rights you're going to allocate to that strategic investor. All right, so we have another question lined up. Anand, you can go ahead.
Yeah, hello everyone. Anand this side. My query is regarding the valuation. I started my business is 2018, and in the first year, we had just a business of 2 lakh rupees in a year as a trial run. Then within 2 years, we reached above 1 crore a year. But due to some medical reason, in last 3 months, our business fell to half just due to some medical reason. So I need to understand that in that case, how will our valuations will get affected and how the valuations are done in these cases.
Anand, look, valuations, right, at this stage, right? I mean, Karthik does a session on this usually, right, in our classes that we do. Valuations are, at this early stage, right, is more about, art than science. There is no objective criteria, to put number, based on, say, X revenue or not, at a very early stage that we operate in, right? Especially pre-seed, seed, and, Series A also, almost. It's mostly a function of, the business potential that, the investor is willing to see, and, and also a function of the demands and supply quality that, is available, for a particular kind of startups in the ecosystem. So sometimes the same company in a similar market, right, would command a higher valuation, but another company would command a lower valuation. Maybe let's say, that has that, for example, that could be that, the founder is a second time founder, or who's already made an exit or something like that. So I think it's very hard to, objectively give you an answer saying, this could be the valuation, basis this, at least at this stage of the company. I'll ask Karthik to add more to that. Yeah.
Yeah, absolutely, Anand. Look, I think when investors are valuing your company, right, they're actually looking at only one or two things, right? Not necessarily where you are at in terms of your revenue, especially if you're in very early stage, like 2 lakhs, 3 lakhs. And if you're a tech startup, right, that's a very small revenue for investors to actually think of you as a business, which has figured out where the cash flows are going to come from in the future, and then put some financial model and give you a valuation, right? Rather, what the investors will be looking at is what is the risk at which I'm entering into this company, and what could be the rewards potentially that I'll get from this, right? And also the um, uh, and also the ownership, right? The amount of ownership that they want to take. So those are a couple of things that investors will keep in mind while setting the valuation.
Okay, but I have one query that in most of the cases, it is considered that tech is a startup, but as our business is on a traditional mode right now, and we are looking for funds to uh, develop it into a tech model. Like we are into selling of packaging material, and we are looking to develop a marketplace for that. So That will that be considered as a investable asset or not?
Anand, difficult to give an answer straight away, right, with these things. But look, everything is today, influenced by something or the other from technology, right? So you'll have to make a full assessment, before giving an answer, is it investable or not. So for example, packaging, there's a startup which does only packaging, right, platform called, if I'm right, it's called Bizongo, I think, right? They just do only packaging for large enterprises, right? So that's a platform play, right? And that is a company which has got funded. So today tech, right, is almost there, all pervasive. So I don't see, but you need to show that there is tech and there is scale. When you use tech, right, it provides scale. That's what people want to see, to make it VC investable. Can it scale? Can it scale massively? If the answer to that is yes, right, and if you show that you have the size of the ambition to scale and you have the potential and attitude to scale, I think then it becomes investable. I hope that answers, Anand. Thank you.
Yeah, yeah. Thank you. Thank you.
Vinod, I think that's a nice segue into my next question, and I have a couple of other guys lined up. If you guys can just hold for a couple of minutes, I'll get to your questions as well. So we know lifestyle businesses, right? This is something that a lot of founders hear from investors when they say, "Hey, look, I'm doing this business, and I would like you to invest." And the investors will retort back saying, "Hey, look, this looks like a nice lifestyle business, but this is not investable from a VC point of view, right?" Uh, could you explain a little bit about what that actually entails? Like, what businesses are considered lifestyle businesses? Is it wrong to build lifestyle businesses? What to expect if you're a founder of a lifestyle business?
Well, actually, first thing, the myth that lifestyle businesses are bad should be broken. Look, I think any business is good business, frankly speaking. It is a question on how do you want to build it, right? Like, do you want to build a large business, you want to build a fast growing business, or do you want to build for your size of ambition, right, what you want to build? I think there is no bad business per se, or lifestyle business is bad or something, right? See, I think typically what people call it as lifestyle business is that um, you are comfortable growing it at your own pace without taking much of an external capital, building a sustainable business in terms of profits and cash flows. And you really are not in the game of market share, trying to capture and grow into a massive business, which is what venture capital funded businesses are expected to, right? That's why they're funded in the first place, so that capital is used to grow the company. So there's nothing wrong, right? Imagine, there are a bunch of people whom I know, right, who run like a 5 crore, 10 crore annual business, right? That's like pretty good, right? Imagine you have like 10 employees, and if you're running a 10 crore revenue business in the 2 crore EBITDA, why would you want not to run, right? From an individual level, right? I'll be very happy, frankly speaking, right? But that's like, let's say that's my measure of my ambition, right? But there could be somebody else who'll say, look, no, I don't want to run like a 10 crore business with a 2 crore EBITDA, but I want to run like a $100 million business with a 20 million EBITDA, right? That requires capital, that requires thinking, that requires effort, that requires a lot more, time, effort, and ambition, right? I think that is the VC scale businesses. And there's nothing wrong, to do a business, which suits your lifestyle. That's what I would say in short is a lifestyle business. Yeah.
All right, thanks, Vinod. We have Jay. Jay, if you can unmute yourself and go ahead.
Hello everyone. I had a couple of questions, but I would start with the first one. Since I think Java Capital investing in a seed stage. So in a seed stage startup, what does a investors look at? What are the metrics they look at before investing in a seed stage startup, or the startups who are raising their first check?
All right, Jay, I think I'll take that question. I know there's a little bit of noise coming from my end, but please bear with me. So, look at Java Capital, right? We take into consideration a whole bunch of different variables into consideration before making investments, right? But broad guidelines are, how large the market is. One, what are the founders? What is the we would like to assess the capacity of the founders. When we say founders and assessing their capacity, right? We look for some of their intangible sort of qualities, right? That we would like to gauge, not necessarily in terms of which university you've gone to or what are the skills that you have in terms of a particular technology, right? Which is also important. We're not saying that that's not important, but when we look for founders, does the founder have the temperament to take this company from 0 to 1 and from 1 to 10, right? uh, can he or she build a large team? Can he or she does he or she has an understanding of the market in which he wants to play? And more importantly, do they understand what the problem that he's trying to solve, and can he solve it effectively and in a disruptive fashion, right? So these are some of the things that we look for before we make a decision to invest, right? There are some companies which may have some early traction, and they may have some revenues. If you have that, I think it's good to have that. It's actually a good thing. But if you don't, right, I don't think we necessarily discount them. But having said that, more likely than not, we at least look for a minimum viable product coming from your end, right? Which means that the founder has actually put some thought into this problem, in solving this problem, and has already come up with a minimum viable product, right? Which may not have all the features, but at least it's a start, right? So those are some of the things that we look for. Vinod, would you like to add anything else?
Karthik, I think that's good. I think I think that I think and the lens of each investor, right, is very different. That's something that you need to keep in mind also, Jay, because we may have a different lens. Between me and Karthik itself, we could have very different lenses. So it's hard to also say, right, this is the only thing. But these are like some of the strong pillars of the framework. And top of it, each investor could have their own thought process and experience that they bring, in when making a decision to invest in any company. So there is a lot more, to that beyond the objective possible principles. There is a lot of subjectivity and experience and exposure that comes into decision making. Yeah.
Yeah, that was insightful. And so I think last question I had was a like many times founders are in dilemma, or they before pitching or sharing their pitch deck is like, if the investors having a portfolio of the competitor startups, should they go ahead and apply, or if the investors are not interested in investing in the competitors startups of their portfolio. So how in that situation, how can founders go ahead?
I think that, Jay, that's a very good question, right? Look, if you think, if it's a very direct competition, right, then I think, better not to apply. But also, right, I would say, right, sometimes, we don't know exactly what is competition or what exactly it could just be an adjacent area, right? So it maybe, instead of sending and sharing more information, you could just volunteer saying, minimal information and ask them, would you consider this as competition to your any of your portfolio, or would you invest in something like this, with maybe, minor variation, possibly. Sometimes, right, it might look a small difference. Like imagine, for example, furniture rental versus furniture selling. It's two different areas, right? But if somebody thinks of that as furniture retail as a story, right, then they may not want to invest, isn't it? So I think there are nuances, and each investor again, right, thinks about, do they really want to fund competition directly, or there could be some adjacencies, which they are okay to fund actually. And the other thing also to look at it, sometimes funds, right, are across multiple funds, right. They may be willing to actually fund, because it's across multiple funds, because they may not invest from the previous fund into the same company again. They may be open to actually investing. But most cases, right, at least in the Indian context that we've seen so far, at least most of the early stage funds in India, right, don't seem to invest in direct competition. But a late stage guy, like somebody we've seen, right, Tiger invests across, competition, right? So how do you go and tell somebody like that, what do you do? Like, that's what we've seen in the ecosystem. So I think it's not a one size fits all answer. uh, I think you should write to them and ask, do you invest in competition? And first of all, do you consider us as competition, right? You may consider them, but do they also consider, or did you see it in a very nuanced way? I think that's important to find out before you share more information. That could be helpful for you.
Yeah, like sending a one liner or a
See,
summary of
one
what.
liner, yeah, one liner, nobody will respond, Jay. That's another problem, right? You need to give
Yeah.
them, so you need to give them maybe the website, because what is publicly available, give it to them packaged well without sharing any private, confidential information, right? Which can at least give them a sense of what the business is, right? See, how do I assess interest if this company is actually competition also, right? But if it's straightforward, right? Look, if you are selling something exactly same as what they're already selling on the website, then it's straightforward competition. Then you should take a call. Do you want to ask them or not ask them? I think you should not ask them. If you think they're direct, straightforward competition, and it would make sense not to go to the TC. But I'm
Yeah.
saying it's very difficult to assess competition itself. I've seen that even in a signing agreements, right? How do you define competition itself is like a time-consuming process in most agreements, right? So I think you should look at it, much more nuanced. There is no easy answer, but direct competition, don't go. But I think if it's an adjacent area, you can actually talk about it and talk to the VCs. Yeah.
Okay. Okay. Thank you so much.
Okay, Vinod, thanks for that, Jay. And there is another interesting question that we keep hearing, Vinod, which is, should founders insist on non-disclosure agreements with investors?
I think, look, at the time of evaluation, right? I don't think so. It makes any sense at all for investors, and I think we ourselves don't sign NDAs. If anybody asks, right, to sign NDAs, we say, look, we don't do it, and it's okay. If we have to move on. I think the reason from an investor's viewpoint, of non-disclosure agreements while evaluating companies is, right. Look, the stage that we are operating in, right, we see like on an average, let's say 200 companies every month. There are obvious overlaps between one and the other kind of companies, right? And if we sign an NDA with each company, right, then potentially we can't talk to anybody after a point in time. So I think non-disclosure agreements are a no-no in the industry. Nobody signs a non-disclosure agreement. I think you have to uh, trust and believe that they wouldn't share any confidential information that you may actually put that. But it does happen sometimes in industry. I wouldn't deny that, right? Somebody looks at somebody else's information and shares it here. It's not like it does not happen. It doesn't rule out that. But at the end of the day, this is the reason why investors don't sign a non-disclosure agreement at the evaluation stage, at least. Yeah.
Yeah, but I think there is other ways for founders to judge the investors, right? When they are sending their material or deck or whatever, check for the track record. Any reputed venture capitalist in the market, right? Would not want to take your idea and try to do it themselves. I mean, they don't have the time, first of all, and that's not the business that they are in, right? So I think if you do a quick hygiene check online or speak with somebody from their portfolio, you would know whether something like that could even happen, right? So I think from our point of view, NDAs, founders insisting on NDAs should not be the reason why they are not reaching out to investors and raising funds, right? I think that should be 99 out of 100 cases. You have to erase that out of your minds. um, okay, we have another question from Anand. Anand, go ahead.
Uh, my question is that what is the right strategy to pitch in? Like, go to the multiple investors at the same time, or just go to a single investor, then wait for his response, then on the basis of the response, move to the next.
Um, Look, Anand, I think the right strategy is the strategy that works for your situation, right? Um, Look, we've seen founders where they engage with multiple investors at the same time, and there is nothing wrong with it, right? Just as investors are looking at multiple companies, there's nothing wrong with founders having conversations with multiple investors at the same time, right? And I think you should be doing that as well. If I were a founder, that's what I would do as well. Talk to as many investors as possible, and see what they think, right? But if you are just getting on the fundraising process, and you want to figure out what your pitch is going to look like, and so on and so forth, right? I would advise you to take a couple of advisors who may be working with you, practice with them, and take their feedback, and start pitching to the investors, right? I would also go a little bit further and bucket the investors into different lists, right? The nice to stretch investors would be somebody who would be amazing to have, but you may have you may think that it's not the you don't have the best shot to get that investor on your cap table, right? And then you have the reach investors, which could be a bucket of investors who could potentially come and invest in your company, right? And you know the other bucket would be the sure shot kind of a people, where that these guys will definitely invest, right? So I would put the investors in these buckets, and then figure out a strategy to pitch to which investor when, right? There has to be some method to that. Instead of pitching everybody on the same day, just pitch uh, to each investor, get their feedback, and see if it's a legitimate feedback, and maybe you need to work on something and change it. But it's not unusual. It's actually common practice for a lot of founders to simultaneously pitch to multiple investors, right? So within a week, they would be speaking to like three, four venture capital investors, and all of them could be evaluating at the same time.
So, Karthik, can you please suggest some advisors as you suggested? They can, which can help me to enhance my pitch deck or financial modeling or any other uh, document or the presentation, which can actually attract the investor to fund in my business.
Look, Anand, if you're an early stage founder, right, which means you're in pre-seed or seed or even Series A, right? I think it's not really advisable for you to get somebody to do your deck and to tell you how to pitch. Rather, you should find somebody who is working with you, right? Maybe if you have a subject matter expert who is giving you some feedback on how you're building your company, right? You can prepare the deck and pitch to that person and take feedback from him. That's what I meant, right? I don't mean that you should hire an investment banker and then have that person do your deck or tell you how to pitch. And I think that's a wrong way of approaching investors, because I think investors will look for the passion and the connect that the founder has to the idea. And oftentimes, if you have an investment banker, that is lost. Having said that, we're not saying that you should completely, if you think that you need help from investment bankers, go ahead and take it. But generally, for us, we would love to listen to the pitch from the founders, from their point of view, from their angle, right, rather than somebody else's angle.
Okay, thank you.
Okay, thanks, Anand. Amrit, you can go next.
Hi Karthik, thank you for having me. So I have a question around, like, I have a startup running alongside with my job. So I was, thinking of starting this funding request once my startup reach a particular level that I think of, from where I can go ahead. It's been 2 years for me running my startup with my own funds. So still I'm not able to take it to the point where I think, funding. So there is this dilemma with me that should I reach out to these fundraisers in the start, or should I be reaching out to them, when I have reached a certain level of achievement in my startup, and then I can sell my, idea to them in a better way. So I just want to know, like, if this is the right way, or I should be going ahead with fun, talks in the start only.
So, Amrit, what do you mean by at the start? You just started the company. Is it in the idea stage?
No, it's a 2 years. It's fully executed. It's working on. I have few phases planned. So one of the initial phase is already been executing, and it's been going on. But for the second phase, I needed some fund.
because it's an idea where the fund should be required and all. So I wanted to wait for it to happen initially, or then reach out to investors. So should I be like reaching out to them and then move ahead the phase two?
Got it. So, Amrit, look, uh, people get funded at all different stages, man. At paper level, idea stage. Some founders don't get funded. Even after showing a certain level of revenue, right? There are various reasons, right? Right. What you get is basis, an assessment you will get as a feedback. Right. What I would say is whatever, because see, it's very hard to tell, is a company fundable or not, right? Uh, Instead, right, you should think about first, go and pitch to a few people, investors. I'm saying first two three investors. Look at what is the reaction. Then basis that interest, you could decide, is the product ready for funding or not. Frankly, that's one way to do it, because it's very hard for me to tell, right, at what stage you should take funding, because you can take funding at any stage, right, depending on what's your vision and what do you want to execute at, right? Because we've seen companies taking it at idea stage, some companies taking it only after they achieved certain product market fit, some at MVP, right? So there is no what do you call particularly defined stage. So it depends on what your business is, what's money required, and what your story that you're going to tell. But if you want to validate, are you ready for funding? Maybe you should just talk to one or two people first and make an assessment. Are you ready for it or not? In terms of feedback that you would get. That's one way. But or if you've achieved good traction, right? Investors like where company is shown a good traction, and it is ready for scale, and money is required for scaling and not for because you already spent 2 years. You're saying, right? That means the business should be in some shape or form where the investors should be able to see value for the last 2 years. And if that value is already there in the business, I think then investors should be willing to consider that depending on what you say is planned for the future. Amrit, does that help?
Yes, just definitely, yeah, just definitely some other, view on my re- definitely I like to go for some page. What happens, sometimes when we start, we have a lot of passion with the startups. When the things don't go our way, we need, sometimes we just feel very low on things of changing ways, or let it be and quit it. So what I'm not able to get is a like-minded co-founder with me who can help out with me and have similar passions for me also, the way the idea is. So it is very difficult and hard to get a person to think along the same lines. So is there a way, like, to better find a co-founder? Is there a place, where I can find someone who can I work alongside or with my idea? And any tip on?
Yeah. Yeah, look, finding co-founder is one of the hardest things, right? Frankly speaking, right? Because I believe, co-founders sometimes might happen through some startup meets and all that. But ideally, right, any co-founder, you should have known that person from your past at least for 3 to 5 years, in a previous job or in your school, your college, or somewhere in your past life, right? That associate had to be there, so that you can trust and work together. So it's hard to find, co-founder. So I would say, look in this same circles, the number of years that you spent, right? Where with
Yes.
whom did you spend time? If somebody is there, that's where you're going to find a co-founder. Otherwise, it's just going to be very hard to find a co-founder, yeah, in other means. Uh, and
Okay, thank you.
on, yeah, it's harder. I don't want to give you any false hope. Some people have done it, right? They go find a co-founder in a startup meet, but that's like very, very few cases.
See, I've been to meetups. Sometimes people are like, just faking their, they just want to be a part of any business. So they'll just say, okay, I'll join, then they'll leave. They have other
Yeah,
priorities. They could not align
exactly.
with their goals. So it's been
Yeah.
like, I think the effort I'm putting into the finding the co-founder, rather I should put in my own business with my own work, so that, but sometimes it happens, you need a partner to grow along with. So this is not
So if
happening for
somebody,
me right
yeah,
now. So
or it has to come from an inbound interest, where somebody is saying, "I want to work with you," right? That's the other way to
yes,
say,
yes, yes.
if
Yeah, yeah, yeah.
but I think it's not easy given, so that's the whole problem in finding co-founders. And I think today engineers also become hard to find apart from co-founders. So
Yeah, that can be, found out somewhere to freelance or something. But for finding a founder, it's
yeah,
difficult.
it's hard. It's hard. I agree absolutely. Yes.
Okay, thank you for your point. I thought it's just for me. Well, that's the case for everyone. Then I will look furthermore in this
Yeah,
section.
you will have get lucky actually to find a co-founder.
Yes, thank you, Karthik. Thank you.
Thank you, Amrit.
All right. Thanks,
Thank
Amrit.
you, Amrit.
So we know that looks like we don't have any more questions. We'll just keep the line open for another couple of minutes. If you guys have any questions, please raise your hand and join the conversation. If not, we will be wrapping up the session shortly.
Okay, I think there is a couple of people. Karthik
Yeah.
looks like yeah.
Uh,
We'll take these last two questions. Yeah, Sanket. Yeah.
yep. Hi Ajay, please continue with your question.
Yes, I am audible now.
Yeah, you're audible now, Ajay. Please continue.
Oh, sorry. Yeah. Hi everyone. Thank you for the opportunity. I have a question on. I'll read out a sentence and then I'll frame the question if that helps. So I was just reading of some startup raising fund, and it note said opened up the fund rouse for say amount 3 crore uh, at a pre-money valuation of 10 crore. uh, what would that mean if I read the sentence fully?
Okay, so Ajay, 3 crore is what the company is raising. So that's the
Yeah,
corpus of the funds that they want to infuse into the company, right? So that's clear, right? The
yeah,
other part of your statement is the 10 crore at a pre-money valuation, right?
yeah, yeah, yeah.
So when we speak about, so valuation is basically the what is the value of the company at the stage that you are in right now, right?
Yeah.
Speak it.
Um, Okay, so when we speak about valuation, right, there are two concepts that we speak about, right? One is pre-money valuation, and the other one is post-money valuation. So it's a fancy way of saying pre-money is a fancy way of saying what is the value of your company right now with your existing shareholding in the company, right? For example, you have 1,000 shares in the company right now, right? And when you bring in a new investor, you're going to expand the 1,000 shares maybe by another 100 shares or something, and then you sell the 100 shares to the new investor, right? That's what he is buying, and that's what the
Correct.
3 crores are for, right? So
Correct.
if you look at your 1,000 shares that you have right now, and you're saying that your valuation is 10 crores, right? It's basically 10 crores divided by 1,000 is what your share price is. So essentially, what we are saying is, your value of the company right now, before you raise the funds, is this much. Now, the post money is nothing but pre money valuation plus the amount of fundraise that you're raising, right? So it becomes 10 plus 3, which is 13 crores in this example. Um, i- is that does it help? Is it clear?
Yes, the only follow-up question would be then, like you said, right, shares and the per share amount, pre-valuation, I mean, pre the round raising, when it becomes 13 crore, now what it happens that the number of shares will also increase, right, from 1,000 to, I mean, 1,100, as you said, and we again divide 13 crore by 1,100, right? I
That's
mean,
right. The share price will remain the same, Ajay. So if you take this example, right, 10 crore and then 1,000 shares. I don't know. I'm actually quite bad at math. Divide 10 crore is what?
we can
I
take
don't
10
know.
lakh as an example also. That should be
Yeah.
okay.
So that's like, yeah, you take 10 lakhs and then divide it by 1,000, right? Then you get like what, 100 rupees per share,
100 rupees. Yeah.
right? So the new infusion will also be done at the same share price, right? So for example, if you're raising 1 crore, right, you divide 1 crore by 100. So that's the amount of new shares that you're issuing, right? So
Okay.
your
Okay.
initial 1,000 shares plus maybe
Okay.
another 200 shares or something. So the total shares would be 1,200 now instead of 1,000, right? But the new shares are also bought at the same price as your existing shares.
Got it. Got it. I think I got the answer. Thank you.
Great, awesome. Thank you, Ajay. Next,
Next, thank you Ajay. Thank you for the question. Next we have
Hi
you.
everybody.
Yeah, Sanjay. Please continue.
Can I come in?
Yeah, you can come in. Please continue.
Okay, as for the valuation of a company is concerned, there are conflicting opinions I'm getting from one of my, few of my advisors. So I'm a little confused because my new startup is going to be a lottery-based startup, and as of now, I have already invested more than 2 crore in this, and in my opinion, the valuation of the product as of now should be not nothing less than 100 CR. However, like a couple of advisors, they are saying me that like your product is now worth 700 CR. So now what is the basis for the valuation of the company in this stage of the launch? I can say. Thank you.
So Sanjay, I think that's a tough question for us to answer, right? Because we don't have any information about your startup. Like it, if you're valuing a company at 700 crores, right? That's almost what $100 million, right? So then I'm
Yeah,
assuming that
that's what others are telling me.
yeah.
So I'm a little confused. Yeah.
I think it depends on the stage of your company, right? How long has it been since you started this company?
It's been about 6 months now, and the the break even of my company is going to be 3 months. So that is the biggest base these people have considered, that within 3 months, like all the calculations have been ready. Ernst and Young is involved in the calculations, and they have audited everything, and they say that within 3 months, we will have the break even. So the valuation of your company is more than 700 CR as of now. So when I want to raise funds, so I personally feel that even at 100 CR, I'm happy going ahead with whatever the share of percentage I want to offer in the market. But Ernst and Young is saying that you better go ahead with 700 CR kind of a valuation of the company. So it's complete chaos for me.
Right, Sanjay. I think, look, I mean, if EY is saying that it should be 700 crores, right, then they must have some formula to come up with that. And, you should probably heed their advice, if you ask me, right? But in general, like what I can tell you from what we are seeing from our experience and in the field that we are in and what kind of companies that we see, right? Typically, a company that is 6 month old, right? We don't necessarily care if the company is breaking even or if it is going to be profitable in 6 months or 1 year, right? We know that a lot of startups will keep burning for a long period of time because they're chasing growth and they want to scale significantly, right? Um, so keeping in that mind, we enter at a very risky stage when a lot of things are very, very uncertain, and the valuations are driven by that, right? So any 6 month old getting even a $15 million valuation, right, like 100 crore valuation, right, is uh, is an exception rather than a norm in our industry, right? Which means that this company has something that 99.99% of all other startups starting up doesn't have, right? It could
Okay.
be, maybe a tremendous amount of revenues, or maybe you have a very significant IP that nobody else has, and that's why that is what is driving the value, and so on and so forth, right? But if you're building just another marketplace, right, it's very difficult to justify that kind of valuation, right, unless there is something very, very significant. um, yeah, so I don't know if I answered that question, but if EY or one of these big four guys are coming in and doing your valuation report, right, I think they must have some logic uh, behind that.
No, I'm very sure that they must be having some logic. But whenever I'm telling them that, okay, let's go ahead and you make me meet with some of the VCs so that we can start raising the funds. So they are taking their own sweet time. It's not happening very easily. So I personally feel probably they must have assumed uh, uh, much like 7 times than what I'm assuming. And that's the reason probably the VC is not answering them properly or on time. And here I'm happy even with 100 CR. So that's the reason I said that it's pretty chaotic at my end, and I'm really unsure about how to go about raising the funds
Okay,
because
Sanjay, I
two
think the other way to look at this, right, is how much are you
cheap.
looking to raise? If you're looking to, what are you looking to raise? Like 10
I
crores, 20 crores?
I need about 30 CR now. That's it.
Okay.
I
So
don't
then
need 70 CR.
you should be talking to Series A investors, right? That's the usually what they would be doing. At that kind of fundraise, 30 crores is about like $4 to $5 million is what you're looking to raise. So you should talk to some Series A investors. What I would do is, just reach out on your own to one or two investors, it's very easy to reach out to them, right? So shoot them an email and say, hey, look, this is what I'm doing, and this is what I'm expecting. Can we have a chat, right? So that's another way of testing whether you are anywhere near the market or not, and you'll probably find some answers.
Okay. And where can I find this Series A investors? Any portal?
So Sanjay, there's a guy called Unicorn Baba on Twitter. He puts a public Excel sheet. You should take a look at it. It has email IDs of all the investors.
Excellent. Unicorn Baba.
Yeah, Unicorn Baba on
Cheek.
Twitter.
Perfect. Perfect. Thank you.
Thanks to
Thank you, guys.
Unicorn
Yeah.
Baba.
Thank you.
Thank you, Sanjay. I think we just have one last question, and then we'll wrap.
Yeah. Hello.
Hi, hi, dude. Please
Yeah.
continue.
Yeah. Hi. Yeah. Fine. So before I begin, I'm going to give a small 30 seconds context. So my startup is a SaaS model startup, and it's like so I just want some of about fundraising. So especially it's based on seed fund and pre-seed fund. So my startup it's like a fitness app for students on education sector, because students nowadays they're not able to recognize what are the mistakes they are making while learning. Just because getting doing hard work doesn't mean they can score good marks. Understanding level of concentration, interest, and there are many more parameters. So what we did is we created an app and we launched it on Play Store by last year. And using the AI, we are able to assess the students' metrics where they are lagging. Is it the study time, or the writing part, or the revision part, or understanding part, or the interest? So there are many other variables. So what we did is, after getting few traction, we went on pitching to investors. So the feedback we got at the most of the time was, get more traction, or gain more experience. Like get more traction was the common feedback. So I was raising for around $200,000, since it's a tech startup, and we are looking at an industry of $70 million in India, with the students space and those who need help, obviously. So what will you recommend for my startup? So most of the people whom I met forced me to go for a seed round instead of a pre-seed round, because I guess pre-seed round is where you invest so that the startup picks up initially, before scaling well the product is ready. And since we need more AI experts into this, and I'm the sales guy, I'm the marketing guy who does this research and sales, and I have two co-founders who are working on the tech part, but we need more resources. So for that we are raising a pre-series round. So what will a pre-seed round, sorry. So what will be the optimal action which I need to do now? So should I need to go on to the market? But the thing is, like, we lack resources for the completement of the product, for the finishing of the product. So we are looking for support, and we're looking to grow also the same way. So is it okay if we still focus on the pre-seed fund, or we need to gain more traction and we need to go for the seed round? So because going to the seed fund is difficult at this moment, because of our product is not yet completely finished. So we are looking for pre-seed round, but the investors are not yet ready to invest around that money. So what will advice which you will give, which will be more valuable to the start? So that's my question.
Dude, look, if pre-seed guys have already not bought into the idea, right? I think you need to ask that question: why have they not bought into the idea in the first place?
Yeah,
If they are demanding traction, that means they are not yet convinced fully, right? Like some cases they demand traction, some cases they are okay to fund, right? I think the
yeah,
answer to the question, I think, is less so a seed or pre-seed. If you ask me, the answer
mm,
is your business model viable? Have you shown validation of the business that this can be a large business and potential for business? If that is there, right, I think people will fund the pre-seed or seed, right? All these names are fine, whatever we could call it,
okay,
right? But see, attracting whatever capital, right? You just need to find that little capital that you need to take off, right? That's what you're looking for. I think it's the question on your business. Ask yourself,
yeah,
why am I not being able to raise pre-seed also in a way? Then you need to show that there is something more that I should show on the product side or on the minimum viable product side to convince somebody to give me money. If not, let's say seed investor, pre-seed investor, then go to angels, right? They are the ones who will give you
mm,
money at this stage for you to take the product to the next stage. Do that instead of chasing only the institutional seed and pre-seed or seed investors. take money, grow it a little more, build the product, show that this is a great product. Then I think people will come back and write a check for you.
Okay. Thank you so much.
Thank you, dude.
Okay, Karthik, that's a wrap. I'm
That's
assuming.
a wrap.
Sanket,
Yes, thank you so much, guys, for joining us. Really appreciate it. We will see you again next week, same time. Join us at 6 o'clock. We are live on YouTube and Twitter as well. Thank you so much for joining us. And
thank
happy
you all. Bye
Ganesh
bye.
Chaturthi and take care.